Hi, in this video, I am going over calculating net present value when we are considering the impact of taxes and the depreciation of the tax shield. So net present value is evaluating future expected cash flows to determine their equivalent today when considering the effects of the time value of money, such as interest and inflation. It's often used for project evaluation in determining if a company should start a new project. There are multiple ways to calculate it. You can use financial calculators, a spreadsheet program such as Excel or Google Sheets, and oftentimes in classrooms, you use tables provided in textbooks. I'm going over the table method in this video. So here's an example problem. Lisa is working at a small travel agency, and we have some expected cash flows and an initial investment that she's considering. You might want to go ahead and pause the video for a second and read through the problem. Okay, so our first step here is considering the tax effects. So Lisa is expecting 4,000 in annual net cash flows. However, we have to pay tax on cash flows from those operations. So really, the remaining amount after tax is the benefit. So what we can do here is take our cash flows, multiply it by 1 minus the tax rate to find that remaining benefit. And so in this case, when we multiply out the cash flows, we determine that the net benefit is $3,000 after taxes. Next, we need to consider the impact of depreciation. Depreciation is an expense on the income statement. However, a company never pays depreciation to anybody. It's a non cash expense. We don't write a check for depreciation like we do utilities. Since depreciation is an expense, though, it does reduce net income, and net income is what we pay taxes on. So depreciation does result in a tax savings and a cash savings because we don't have to pay out as much cash for taxes. This is often considered a depreciation tax shield. So to calculate our tax shield, first we need to calculate depreciation. So a little refresher, our depreciation is cost minus salvage value divided by useful life. This is the straight line method if you remember. So here we have our initial investment or our cost, our salvage value, we divide it by the useful life, and we determine that our annual depreciation is $1,125. Next, we're going to consider that impact on taxes. So again, depreciation is an expense that reduces net income, and taxes are paid based on a percent of net income. So what we need to do is take our depreciation that we calculated above, multiply it by our tax rate to determine how much tax savings it's going to result in. In this case, the depreciation results in tax savings of $281.25. Now we can look at our overall impact of our cash flows. Hide that for you. We have the initial cash flow and now the effects after taxes. Notice that for the annual cash flows, we have the 75% remaining after paying tax. For the depreciation, we have that 25% tax savings, and there is no considered tax impact for the salvage value when we sell it and that initial investment. Also notice I put the initial investment as a negative number because this is our only outflow that we have in this situation. All the other ones are considered tax inflows. Now we can calculate net present value. So when calculating net present value, we need to consider the timing of cash flows. Cash flows happening today do not need to be present valued because we are in the present. So things like your initial investment don't have to be adjusted. However, cash flows happening in the future need to be discounted back to determine the amount in terms of today. Some cash flows only happen once, like salvage value. We can only sell our equipment one time. Repairs might also be a one-time event that would come up. Other cash flows are annual, such as annual operating costs or other expenses or potential inflows. If those annual cash flows are the same amount every year, that is what is considered an annuity. So in our example, we have our annual net cash flows. Those are happening every year from years 1 through 8. Then we have 2 one-time events, our initial investment and our salvage value. But again, we cannot forget about our depreciation tax shield. That one is also happening every year. Next, we need to figure out the periods that that's impacting. So again, the ones that are happening every year is happening periods 1 through 8 because it's an 8-year project. For those ones, the table we would use to calculate present value would be the present value of an annuity table. For our one-time event, our salvage value, we're going to use the present value of a single sum table. And again, our initial investment is happening right now at time 0, so we don't really need to multiply that by any table. Here's an example of 2 present value tables you might find. So again, my present value of a single sum is for my one-time events, and my present value of an annuity is when we have annual cash flows, the same amount every year. Okay, now we need to figure out where to look on those tables. So it tells us in the problem that Lisa only expects to earn a 5% rate of return. So that's the discount rate we're going to use. And our project has an 8-year life, so that is the N, or number of years, we're going to use. And this is an annual calculation, so we don't need to make any adjustments as far as our number of years or our rate. We can just go straight back to our tables. And for my one time, I'm going to go to the 5%, 8 years, and identify my factor. And then I do the same thing for my annuity, 5%, 8 years, and identify those factors. Notice the factor for the annuity is larger. That's because it's taking into account that the cash flows are happening every year. I can go back now and plug these into my table. So we have our cash flows, the after cash effect that we calculated, the factor that we determined using the table, and then we're going to take that cash after tax effect multiplied by the factor to get the present value of the cash flows over here. We take that column, subtract the initial investment because that is our only cash outflow, and that gets us our net present value. So the net present value for this project is $11,581. It's a positive number, which means Lisa should do the project. I hope this helps you, and have a great day.